Good morning, everyone. This is Darius Dell here, Senior Analyst on the Hedgeye Macro team, to welcome you to another fantastic edition of the Hedgeye Macro Show for Wednesday, June 5th, 2019. I'm joined in the studio with Hedgeye CEO Keith McCullough. As always, if there are any questions, just pop them into that chat stream. We'll try to get to as many as we can before the end of the show. With that, take it away, Keith.
All right, Darius, nice big audience for us this morning. Again, today is free for the newbies, and welcome. We appreciate your time and certainly your attention to the process. For those of you that are paying for this, thanks for your patience as well. I'm going to explain a couple things in its most basic terms today. Hopefully that doesn't frustrate you. Top three things, what we do every single morning. We do the top three things that are moving in macro that the old wall and or its media is not focused on because they don't have a process to do so. Okay, we focus on that. Then we'll go through the entire edifice of global macro risk across countries, risk ranges, again, commodities, fixed income, not just staring at the Dow, bro, in points. Okay, so the first thing this morning is the Nasdaq. The Nasdaq has a big bounce, off an oversold signal. So again, at the low end of the risk range, we call it immediate term trade oversold. So that's point A. Point B is that PE, private equity pal, came out intraday saying, hey, we agree with the Hedgeye view that at some point we could consider a rate hike, rate cut being. Don't forget that rate cut, imagine you did a rate hike. Rate cut would be the best thing ever. You don't have to get anything right fundamentally. The economy, corporate profits, or anything. You just buy stocks. No, don't do that. Okay, so at the low end of the range, it was gonna go up anyway. At the top end of the range in the NASDAQ, which is now 77.22, you're a short seller. Why? Quad 4 economic conditions. So again, you're seeing that this morning in the ADP number. That's why the 10-year yield collapsed down to 208 from 212 when I got up this morning. Again, economic data is setting up to deteriorate at a faster rate. That's what we call Quad 4. Quad 4 is when both growth and inflation and profits, which is a function of growth and inflation, both growth and inflation are slowing, profits are slowing, and the Fed is, again, going dovish as the market's getting more concerned about those fundamental facts. So again, we'd be a short seller of semiconductors at the top end of the range. That's one of the juicier spots to be. SMH on the short side, we shorted a semiconductor stock yesterday into the close. It was up 5% and change. You'd have to pay for the subscription to know what that is. Point number two this morning is oil. Now, oil, no bounce. So I wake up this morning and I don't have a chart of China, but believe me, in the words of your favorite president, it didn't bounce. So China didn't bounce, copper didn't bounce, oil didn't bounce. Oil's actually down 1.3% right now, okay? That is getting quad 4'd. So again, in quad 4, we are short of tech, we are short of oil, we are short of energy in tech, oil, and energy terms, okay? This is not doing this in any other way. This is just shorting them on the bounce. So again, we're getting confirmation away from, once you get through the, I don't know, the Dow upbound Joe Kernan thing, you got to focus on what's happening in the rest of the world. And the bounce in Europe in particular was like underwhelming, suffice to say. It was a wet Kleenex. So all the things that would actually see follow through if this was indeed like December the 24th, which everybody wants to call again because you're anchoring, because you're humans. You have those biases. You go back to the most recent point and you say it has to be like that, or maybe it'll be like that. But what if it's not? What if it's 2019 and you're coming off the peak of the cycle and again entering quad 4 is where you're short oil. So again, that is going to again leave a mark on people with oil volatility up at 43, could easily go to 50, oil vol. If you don't know what oil vol is, you're going to learn something this morning. Please look that up, OVX. Even the most basic chartist could tell you that that is a bullish chart, which is a bearish chart for oil indeed. Point number 3 this morning, Italy. Who's talking about Italy? What's interesting this morning is that people would normally talk about, if they didn't get the Fed into the game here, China and Europe, heinous economic data. Like look at this economic data this morning, by the way, in China, which again, why is Italy down? First of all, Italy, forget no bounce, it's down. Like oil, it's down. And you have, the best thing Italy could do is put up a 49 and change PMI number, whereas, again, the Chinese PMI number slowed again in May. You have the Russian PMI number even, which is one of the only good-looking markets out there, also slowed in May. You have Spain slowing again in May. So again, the problem remains the problem, which is, again, you can't eliminate the economic cycle. While it's nice to imagine and consider the idea that P.E. Powell and the vice chair of the Fed could come out every single day, twice a day, with tweets and save you from everything that is the cycle, the damn cycle won't go away. So again, stay with the process this morning. When you look at the entirety of it all across Asia and Europe in particular and the flow through to the U.S. equity market, you may have seen the high of the day in U.S. equity futures. I'm definitely not a buyer of those here. I'm looking to make short sales in the things that we do not like in Quad 4, and those are your top three things. All right? Mm-hmm. Top three things. That's all I did. Yeah, top three things. That's only like three things in all these things. What's in here, guys? I got a lot of stuff. That includes everything, okay, that I look at. Across global macro, Asia, Europe, rates, commodities, currencies, etc. All the different things that happen. All the tickers that could be embedded therein. This is just to get started. This is just your big morning data dump. That's what gets you ready. You don't get up in the morning and feel something about the market, get somebody on TV to have you think a certain way. That's no process. That's, if you want to do that, you might as well just go gamble. I mean, and gambling actually has some pretty good odds if you play that by the rules. So what we're giving you is a rules-based process that includes A, where is the fundamental quadrant of an economy, and B, where's the market signal. So again, we're not applying some level of hubris, which is, well, because the valuation is attractive, I'm going to buy this security. How many times do you hear people say that? You'll hear people on, I'm not going to name names, I would never do that, but they'll always start with valuation is attractive. These people have never built a model in their life on the company. They don't know what the real numbers are and what the real valuation is. Just stop. Let's go to where's GDP going, where's inflation going, where's the Fed going, where are profits going, where are credit spreads going, and now we'll actually have a good repeatable process to start to execute on. So let's just do that, and this is what I do every morning is I go around, take a run around the rain room, if you will, after I take a shower, and I'll go around all of macro, talk about the risk ranges and things that I'm seeing that are away from the top three things, and I'll do this relatively quickly, okay? If you don't like that I speak quickly, you would not like if I spoke slowly, or if I sounded like somebody on CNBC that had an accent. The economy is not in a recession, therefore I am bullish. You see how long it took? It's just terrible.
You forgot your bow tie.
Yeah, just
I
terrible.
wear a bow tie.
Yeah, it's just terrible to listen to because it's just terrible. Okay, 27.29. You wonder why we're building a new brand that is just a better way. Minus 2.6% downside versus the close, so that's a lot of downside versus upside. This is actually the first day in 3, 28.35, which is 1.1. Can you do the math quickly? You take the prior closing price, again, you do a little bit of math, and you see, okay, today more downside than upside. That's the first day in 4. So again, if you're a subscriber, you know that. If you're new to that, you didn't know that, and that's your little freemium opportunity today. The Russell 2000, which is a certified train wreck, which is minus 13.3% versus where it was on August the 30th. What happened on August the 30th in 2018, Darius?
Ooh, August the 30th, the market topped.
That was the market top for the Russell 2000. Mm-hmm. So it's down 13.3%. That's a place we want you to be short of, okay? So I'd actually it's much more likely that I short the Russell instead of the S&P because less people are shorting the Russell, and we have futures and options data to support that. So again, look at where we are within the risk range. The risk range for the Russell is 1451 to 1537. If I said that too quickly and you don't have my notebook, buy the risk range product because we write down the top 25 to 30 ranges, which include some bullish things. There's always a bull market and bear market somewhere, but bullish range in Bitcoin. It hit the low end of the range yesterday, so I bought a little, if you don't mind. Again, that's in my PA. I don't have a way to signal buying the Bitcoin, but I do have a process to give you where I would buy the Bitcoin. I actually have no idea why Bitcoin's going up, and I don't particularly care. Maybe it's just why gold's going up. So gold this morning, can you guys take a little gander at gold? Up another 0.7% this morning, doing precisely what it should do when the Fed is about to cut interest rates, because at that point the dollar stops going up, at least at an accelerating rate, and interest rates are collapsing to the downside. For any of you that have actually studied gold across longer term durations, you know the number one thing that gold cares about is real interest rates. If real interest rates are falling and falling towards zero, gold loves that because gold is an absolute return currency. And again, the absolute return has more value when the interest rates are falling at a faster rate. So again, that's another way to think about the economy slowing faster is that gold's relative gains pick up faster. Now again, for all of you perma gold bulls, we were bearish on gold all the way up until the end of September of last year, and then we flipped to bullish. So again, nice little looking chart. I only use the chart from when I went bullish. So if you don't mind, it's called a timestamp, and we're accountable to every single call that we make. If you look at volume yesterday, for example, it was actually one of the few days where we had an up day on volume. You should expect that probably up 9% versus the 1 month average, down versus the 1 year average. But again, we study, measure, and map the relationship of price, volume, and volatility. Slide 20, guys, that's the process. If you don't do that, you should certainly consider it. Slide 20, one more time. Trades, trends, and tails are built on that price, volume, and volatility signal. Okay, and on slide 22, you can see or take a gander into how we think about the volatility component, which is again overweighted relative to the surface area of price. Okay, because the vol of vol, as Mandelbrot taught us in fractal math, predicts all else, okay? And again, you should understand and embrace that this is a nonlinear world. It's uncertain. You should also understand that most people on TV have no idea what I'm talking about at this point, and that's a damn good thing. So again, understand that staring at the surface area of price, one factor model, moving monkeys, 50-day, 200-day, 10-day, 2-day, useless. Absolutely useless. Or at least I want them to be gainfully employed to keep doing that, because that's how we make money, is fading the moving monkeys. All right, sectors yesterday. Everybody was a winner, almost. Look at it. And this is what we call, again, looking at the market, just zooming in on the U.S. equity market at the sector style level. REITs were down. That's one of the places that have been up for the last month. So again, up on the month, down on the day, faded. So at the low end of the range, I'm a buyer of real estate. We like the REITs in Quad 4. We also like utilities. Those would be the top two. 1, 2. Favorite two ideas in sector space, utilities and REITs, and now you get to buy them on sale. You will not get to buy Treasury bonds on sale today, unfortunately for those who have not understood the call. Because again, the ADP number knocked the 10-year yield down by another 4 basis points. Off to the races we go in TLT terms, all right? What else do I got going on for you this morning? In Asia, as I pointed out, no bounce in China, but there was a bounce in Japan. So Japan gets up 1.8% overnight, signaling almost immediate term trade overbought. So again, Japanese stocks looked actually a lot like, not surprisingly, the Nasdaq. So you see how that little black line there bounces 1.8%, but you see how the red line, which is a series of lower highs, which is confirming a bearish at Hedgeye trend. So again, if you want to know where the trend is every day, and the risk range, again, contextualizing, making good decisions within the trend. The trend is my signal. The range helps us with the noise. So again, if you get to the top end of the range on the Nikkei, you'll see that in your pin sheet if you're a risk range subscriber, 21,192. Why do I know that? Again, Generon, you can zoom right in there. It's right there. Look at that damn thing. It's just staring at it. It's like a fish. It's like looking at the fish. It's like put the hook right in its mouth. 21,192. And if I do that 10 times, I can be right 7, 8 times. If I'm on a hot streak, our subscribers know I can be right 10 out of 10 times. Okay, if you could, you would. What's your alternative, I ask you? What is your alternative to doing it that way? Kospi, no bounce. There's a lot of doctors out there, the Dr. Kospi, Dr. Copper. They don't really agree with that we're all set off to the races. So again, we're back checking across 27 core macro factors what it is that would have me sell U.S. equities today. Okay, and only the U.S. equity sectors that we don't like, again, I've highlighted those. Those would also include basic materials. So when we look at certain sectors that we don't like, A, don't I like it? B, is it at the top end of the range? And for subscribers this morning, may I submit the C test, okay? The CPAP. Pop it up there. Look at the implied vol. Implied vol. Where's that? Who knows what implied vol is? All of our subscribers know. Okay, so look, basic materials has an implied volatility discount of 16% this morning. There's my little CPAP. I can breathe better on the short side now. I'll short some more XLB today, all right? Again, I'm not going to review why these matter. I don't have as much time as I would have liked. I'm just going to get down to the wood here. Denmark. Happy Constitution Day. I tweeted to you. Denmark's down. Denmark, isn't that a kind of a bummer? It goes all the way back to 1849, and they have Constitution Day. They don't have a national day. They have Constitution Day, and the damn market opens down after the U.S. stock market's up. What's up with that? You know, I love the Danish flag, by the way.
Powell's going to cut rates.
Yeah, I got a nice little, yeah, exactly. And Denmark's down about, oh, there it is. There it is. Beautiful flag. Particularly for Yale guys, because you just like to beat on Cornell all the time. The same colors. We do have a bias. If you didn't know, Darius and I are like the smartest people on the planet just because we went to Yale. Yeah, I hear you there. It's certainly better than not having gone to college at all. Oil, 51.20 is the low end of the risk range there. Again, look at your risk range product. Please don't buy gold today. It's approaching the top end of the range. You buy it at the low end of the range. We had a lot of subscribers whining and moaning about gold not performing in April when they should have been buying it. So we still do have to train our own dragons. We have to train our own subscribers effectively. If you Game of Thrones, they don't always cooperate. So again, you want to make sure that people are aggregating and again, collecting the things that we like when they're not working, so that when they're working, they can sell some, book some gains, and buy their kids some pizzas on Friday nights and maybe the family some beers. What else do we got going on? Copper, already hit on that. Corn still looks good, but it's correcting this morning. If it gets the low end of the range, yes, we would buy corn. 10-year yield low end of the range is now 203 to, wow. Man, this is amazing. This is just amazing, but not surprising. 2.03 to 2.35 is your risk range on the 10-year yield. So again, a couple points I'd make. This is the lowest lower high that we've had, and this is the lowest low that we've had. Okay? So that's good. If you are bullish on Treasury bonds, it remains our #1 asset allocation across the curve, going all the way back to Quad 4 in Q4, and maybe a good spot to take some questions.
Yeah, you might imagine that most of the questions are whether or not this is December 24th. So we're going to skip those because we obviously addressed them. But I do see one.
Well, do people that are asking that question know that December 24th included December of 2018? So December of 2018, let's just show people so that it's emblazoned in their head. Because it's a lot better than, I don't know. They don't know, right? They don't know. Get used to that, okay? Let's just take this away, and let's just write this down for a second. Okay, so December of 2018 was equaled the worst December ever.
Ever.
Okay? Ever is a very long time. So if you are saying today is December the 24th because we're going to call it the worst December ever in the history of humanity, then you're probably not even remotely considering being close to a probable answer that you should start with. What you're starting with is you as a human being are anchoring on a heuristic. You're anchoring on a bias. If you don't know what that is, read Thinking Fast and Slow. Start reading. That would help. Okay? So again, get to a place where, again, you're contextualizing the cycle, the quads, slide 39, guys. Again, in December, we were discounting that the U.S. was going to enter Quad 1 in Q1. Again, however misstated and understated the deflator in the U.S. was. But that China actually had economic data that was accelerating, and Europe wasn't going down as fast as it is now. So again, you have a lot of different things that happened there, and certainly earnings were less bad. Earnings, guys, if you flash it, we're almost done on earnings season. They weren't negative, okay? So now, S&P 500 earnings is what I'm talking about. They're up about 1.5. Actually, I wrote it down this morning. They're up, before you get it up, there you did, 1.57%. Okay, so again, earnings were better than expected too. But now what? Earnings are going to be worse than expected, and everyone's going to blame Trump and China.
They're going to blame Trump and China.
Oh no.
What a gig.
Yeah.
Awesome. All right, let's keep moving. All right, Max asking, with the U.S. in Quad 4, when the U.S. is in Quad 4 and the Fed cuts rates, does that push it into Quad 3 almost immediately? I.e., should we be prepared to pivot back into Quad 3 assets the moment the Fed blinks?
Well, you should pivot back. I would like to think that since I'm the one who built the process alongside my colleagues here, specifically Darius, that when we think that there's a time to make that move, we're going to make that call. I get up at 4:30 in the morning, not for shits and giggles. I mean, I want to make money. I hope you understand that. Some people are like, oh, you market your process. I'm like, yeah.
Isn't that the whole point?
You go, business pro. It's like, what do you think I'm getting up to do in the morning? Again, you can see what I'm doing in the morning. What I'm trying to do is answer that question each and every day. If I thought that that was the answer of the question today, so please eliminate 150 of the questions in the queue right now. If I thought that that was the answer, I wouldn't have titled, Fed fading cowbell or fade the Fed cowbell, however said it. We're making a call. We make a call every day. We base the call on our process. We make the best call that we can. We're the ones who told you that the Fed was probably going to hurry up a rate cut, don't forget. All right? So now everybody agrees with us on that, but nobody knows on the timing. So again, I think that preemptively now people are hoping it's June. I think if you think it's going to be June, you're going to be sorely mistaken because the Fed doesn't have the economic data to support it until July and August, which last I checked, next to ever in December is, again, July and August come after June. So again, after the June meeting, we're going to have Quad 4 economic conditions. But the GDP report, guys, slide 14, you can see where our current nowcast is, which is below consensus. So again, our GDP nowcast, which we, again, recalibrate daily using predictive tracking algorithms. And again, if I've lost somebody who doesn't know what a predictive tracking algorithm or a similar set or a fractal pattern, then too damn bad. You're going to learn quickly if you subscribe to Hedgeye. So we're at 1.58%. So it's not about what the GDP number feels like. It's what the GDP numbers are doing. So you're going to have that number in July. You're going to have the lowest CPI or headline inflation number in August. Then the Fed, ostensibly, if the Nasdaq's down at that point, 15 to 20% instead of down 10% versus where it was only in the beginning of May, then you're going to have the conditions. So that's when I think it's going to happen. If I change my mind on that, I'll let you know.
Yeah, and you heard Bobby Kaplan this morning, Dallas Fed president. He's
non-voter.
Non-voter, but he sort of he represents the general belief of the institution is that they're close to neutral.
Yep.
And so that they probably do need to see these river cards in the form of the data you just highlighted. That'll be out on July 26th. The July CPI reference will be out on August 13th. And then ultimately Jackson Hole late August, and then ultimately the Fed.
That's our setup. That's where we're going to be like, and you know what the risk is? The risk is that that's wrong. I don't think the risk is wrong in selling the first bounce on a Fed whisper or a Fed insinuating what they could do. The risk that none of you have asked about, and please check me if I'm wrong here, but I can usually predict what you won't ask about is the thing hasn't happened yet on your screen. So the real risk is that we buy the damn dip at some point in August. I get my ass up out of the boat, stop fishing. Sometimes I'll have 6 beers in me by the time. If it's late August and you get a real-time alert, I'm not going to apologize for that. That's the way the summer vacay goes. If I get up, if I bring the boat back in, I go all the way up to the house and, entertain the idea of buying the damn dip in something. What if it's not a dip? Back in the boat. I'm not going to deal with that. The Fed at this point, now the market, what if the Fed needs to cut by 50 to 100 basis points to satisfy the market?
It looks like we're going in that direction.
Can somebody please ask that question after that I've asked it now? So again, the answer isn't a straight shot because we gave you a roadmap. Okay, quad 4 scare, then on a quad 3 pivot, Fed actual cut that we're, the playbook says to buy, but the playbook says to buy in Q4 when the earnings, well, not actually, I should say the GDP and inflation comparisons are easier. In Q3, they're tougher and tougher and tougher as you get throughout, again, and through the quarter. So for those of you that don't understand what that means, guys, go to slide 6 in the current macro deck. All I care about is rate of change, okay? The rate of change of me getting out of the boat also applies. The rate of change of the beers, that applies. Everything applies, okay? You don't know what rate of change is? Drink 6 beers, then drink 12. Tell me if anything changes, all right? So let's go. And maybe if you drink them fast, as opposed to slow, then see if anything changes even more faster that way. How's that? No, go to the slide before that, guys. Slide 5, please.
Slide 5, yeah.
So again, last year at this time when we were bullish on the U.S. economy, okay? This is the rate of change, the ROC, rate of change, the ROC. All the U.S. economy did for 2.5 years is move up, 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 up. This was Q3 of last year. That was the peak of the acceleration. So now, on the way down, as the economy goes up, 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 that's going to happen against that. Q3 here, where you're slowing at the fastest rate. Get it? I think you get it. I don't think it's acceptable to not understand 12th grade math if you want to actually make real money in the market. Just a baseline assumption, right? So what would give you the confidence that we're going to accelerate against the peak when every single economic data point that has come into our predictive tracking algorithm, we have 30 per month, 90 per quarter, is slower? What is it? So again, the real question is, are they dovish enough? Did they cut enough? And I think that that'll be the real risk management exercise. Well, everybody and their brother, sister, brother, who, by the way, is in the business of promoting being long only forever, is sitting there saying that it had to be the December 24th bottom.
Cool. Let's keep it with the rate cut discussion.
I like the freemiums show. I get more fired up.
Yeah, I'm fired up too. Let's go.
Play with a little passion. Play with a little passion.
Tremendous passion, that's what our coach used to say. Michelle's asking, do you think Dalio is betting on EM because he expects the US dollar to go down on Fed rate cuts?
You should. He's also probably betting on Quad 1 emerging in EM. So again, we were ahead of him on that call. I don't know if it was a month or 2 months. Maybe he was buying it. Now he's finally told you what he was doing when we signaled it. But again, what that essentially means, slide 90, guys, and this is our Quad 1, 2, 3, and 4, for those of you that don't understand what this is. Quad 1 and 2 are good. Quad 3 and 4 are bad. Okay? Quad 4, very, very, very hugely bad. Okay? So when you look at EM in the aggregate, what Dalio is most likely doing, if he's doing it the way that I think he does it, because I'm pretty sure that I read it the right way and I've studied what he does, and now he has a book called Principles that says that the 2 biggest causal factors in macro investing are growth and inflation. Atta boy, Ray! So what does Ray think here? You got the mean and the mode of all these things, all right? These are all the EM countries that trade, that we care about, okay? So the mean and the mode of the world by Q4 of 19, and right there is Quad 2, Quad 2. What I'm not willing to suck up here is the Q3, Quad 4. Mm-hmm. Yeah, Ray. We have to have a talk about that, Ray. So, I'm a younger man than Ray is now. When Ray was my age, he was, cranking all day. I think he's cranking still, not saying anything like that. But I would say that I just respectfully disagree that you should be buying EM until at least when I get out of the boat in sometime in August.
Mm-hmm. Absolutely. All right, transitioning just back to the U.S. economy here. Bristol's asking, all the U.S. bank credit metrics are accelerating and at or near all-time highs, including auto loans and housing. Should this be a precursor from Quad 4 to Quad 2 or Quad 3 in the near future?
Well, a lot of those are just rate sensitivities. So if you look at the upside down of a 10-year yield chart, that's what they look like. And by the way, we would be a buyer of housing stocks, not a buyer of autos. But again, housing stocks are a buy in Quad 4.
Mm-hmm. Mm-hmm. Indeed. Awesome. YM's asking, why is it always that the worst companies rally hardest on the good days when the fundamentally better companies rise the least? Should it be the other way around?
It's not what it should or would be.
Shouldn't be.
This isn't for purists, right? I'm not your God, and the market isn't your fair value person. It went up a lot because it went down a lot. Got that?
Well, it's also
Something goes down 25%, and then you have the first 2% up day in forever. Well, it might recuperate. You might have a 5, 6, 7% day. But here's a question for you. Let's see if Darius can get to the answer faster than anybody in the queue. If you lose 20% of your money, how much do you have to be up to get back to break even? I'm watching everybody's
30%?
answers.
30%.
How much?
30.
30. Anybody else? Anybody in the queue? If you're down 20, how much do you have to be up? Anybody get it? 25.
25.
Close. So again, you have to be up more than you're down. So the things go up more because they were down more. That's just called high beta. Yesterday, if you look at the style factoring of the market, which again, you would find in my notebook if you were to hijack me like they did Eddie Lampert, okay? So you just take them, you take me, put me in a car, and as long as you give me a computer, we can go through this, all right? So what I'd show you here, actually I'm not even gonna write it down. I got too many things like forever in here. See this right here, SPHB, see that? Can you guys see that? SPHB. Yesterday, the sector exposures that bounced the most were SMH up 4.1%. That's semiconductors. Then it was SPHB, Mucker. Get it right. Damn it. SPHB up 3.6%. You know what SPHB is?
High beta.
Wait on it. High beta. Right? What is the worst place you could have been in the last month? Style factor table, Josephine, please. This is not like fake news, all right? High beta is down a ton in the last 1 and 3 months. So again, when you think about it, it's down 8.9% in the last 3 months. So of course, when you have a counter trend bounce, write that down. So if the Hedgeye trend says short semis, short tech, short semis, short high beta as a factor exposure, that's the trend. That's where all the money's been made for the last 1 to 3 months. On a counter trend day, those things should go up the most, okay? That's your opportunity to get back in. Or for all the poor souls that missed it, your second and third chance to get the hell out.
Indeed. Indeed it is. Awesome. Next question here.
So for example, if the Russell's down 13%, over 13%. You got to be up 15 to get back to break even.
Yeah, probably unlikely to happen.
Yeah, so for all you professional chartists out there that said that the Russell chart looked awesome on August the 30th at the literal all-time high, not good. You don't just do charts. You got to do some research too.
A little bit of A/B process in there. Why not sprinkle it in? Awesome. Here's a question here. It's a great question for our new audience because obviously we don't think in these terms, so it's a good opportunity to sort of brand how and why. Nick saying, are you calling for a summer correction or a summer crash in U.S. equities? You don't even have to answer that question.
Yeah.
Just be
I'm not
positioned.
trying to be on TV, bro.
Yeah. The whole point of the 4 quad process, if I can take a couple seconds, is to not have to make these all or nothing calls. If you're oriented in the right manner across your sector styles, your style factors, your fixed income sectors, your currency markets exposures, it doesn't matter if you're calling for a correction or a crash. Just be in the right things that go up and then don't be in the things that go down a lot in a particular environment.
Yeah, only like a bloviating, reformed, brokering asshole would tell you that it's going to be crash. It's going to be like listen to somebody who's legit, not a pretender, a pro, a real pro. Stan Druckenmiller. Watch his latest interview on Bloomberg, and again, great interview. He says, "I don't know," 20 times over the span of the interview. I don't know. He said, "I bought treasuries in October." I didn't know. He said, "I didn't know that they would act this well. All I knew was that bond yields were done going up because inflation had been done going up. That's all he knew. He didn't know what the ultimate price target or crash or all this bullshit you hear on CNBC. Well, my price target is 20 times earnings, therefore the stock should go to 1596. I mean, that's just like it could only be classified by the people that are playing the game at the highest level in terms of how the amateurs talk about price targets, crashes, corrections, as certified bullshit. Okay?
That's all it is. Indeed.
And they really don't like it when I say that. That's why we don't get along. And if you don't mind, I don't get along with people who are full of shit.
Neither do I. Awesome. Let's shift to the currency market. Got a couple good questions here. Scotty's asking, with the euro and the dollar at the bottom and top end of the respective risk ranges, does the mucker machine care that it's ECB day tomorrow? How are you thinking about position?
I do care about that because, okay, so again, really important question. And again, if now we're not just going to do the daily notebook. We're going to have a tab for every day, these tabs. See this really sophisticated thing. So anything, you would say, okay, you asked me a question. Now I'm going to go to the tab, which is my weekend work, and I'll go, okay, to the calendar part of the tab. Can you guys see? It says calendar. And then I'm like, oh, ECB rates day. So so again, these catalysts matter when they matter. Wait for it. If the euro's at the top end of the range and, oh, there's an ECB meeting tomorrow, well, now it matters. If the ECB is dovish enough and the euro's at the top end of the range, what should I do today? Buy the dollar against the euro. And I will.
Indeed. Indeed.
You don't always get the catalyst, so that's the whole point. If you don't do the work, you're not prepared. So it's just like fishing. If you don't have all the different kinds of tackle, if you don't have a kicker motor to save you, if your main motor goes, too bad. I am prepared, if anything, okay? I work my ass off, and I have a great team, and I'm prepared. So again, it puts you just in a better spot every day so that you actually know what your opportunities are when they're actual opportunities. So what is success? It's when preparation meets opportunity. I mean, I'm not the first one to say that, but essentially that's why you have to prepare on the weekends for what's coming up in terms of those weekly macro catalysts.
Yeah, totally. And that's more like a fractal of what's actually happening too, because you think about, okay, now we're in this one particular week, this is the current market setup. I'm going to take advantage of the current market setup with respect to this catalyst. But if you think about taking it broaden it out from a fractal perspective, we're constantly thinking about the next policy catalyst all the time.
Yep.
Where's growth and inflation headed? How can we get in front of the policymakers reacting on a lag to changing growth and inflation statistics? That's the whole point of our call on the ECB. Quad 1s have turned into Quad 4 in Europe. Europe continues to slow. Inflation continues to slow, which likely should bottom out in Q3. But again, that you're going to get a dovish ECB from here, as far as the eye can see, really until we see the whites of an eyes of recovery, which is very unlikely to happen until Q4, Q1.
Exactly. And another thing to think about, like when you're writing all this stuff down within your notebook, and again, considering the similar sets associated with a fractal pattern. Look it up, please. If you, at a bare minimum, learn something today when it comes to the basic assumptions we start with, okay? There are similar sets. So when you have growth and inflation slowing at the same time, bond yields on the long end of the curve go down. I don't know why Gunlack doesn't know that anymore, but he should know that. And maybe if he's watching this for free today, because we don't do business with them anymore, you can imagine why. But again, it's a very basic, similar set. It's not a super sophisticated fractal pattern. That's what happens. So again, as interest rates are, you can see it this morning. You have a negative 21 basis. Again, this is all in the notebook. What are German Bund yields this morning? Down 21 basis points, negative 21. Swiss yields minus 0.53. Minus 0.52, whatever they are. They're reflecting on the similar set, growth and inflation slowing at the same time.
Yeah, just a quick market update. German Bund yields are at minus 23 basis points.
Minus 23 basis points. So there's another good example of how somebody might say, well, this guy, I just don't like his style. I don't like his cartoons. Because he said that I wasn't very bright because I bought I basically bought puts on German Bunds because they were expensive. It's not. It's just a dumb thing to do. I don't know how else to say it. I mean, it's like if your kids are ever coached by me, you can try this for real. I don't care if they're 8, 10, 12, 15 years old. If you do dumb shit on the ice, I'm going to tell your kid, and maybe not use those words, but I'm going to say, you don't want to do that. That just doesn't work, okay? Now, some people on Wall Street get really offended when you do that because they've been their whole life. I had the lowest SAT score at Yale. You can imagine the ones who had the highest have never been told they're wrong on anything. But when you look at their returns and their process, it actually has been proven to be wrong for 5 to 10 years in some cases now. And that's really annoying when you have somebody come out with a better way. And that's the point. We want to say, we're not buying German bonds because they're cheap. We're buying German bonds because growth and inflation quads are slowing. That's it. So easy a Mucker and a Big Darius could do it, okay? If you don't mind.
Yeah, exactly. All right, let's keep moving here. Questions on the dollar here from Matt and a few others. Can you explain the recent dollar weakness in the face of the Quad 4 scare? Do you have plans to buy at the low end of the range, or is it threatening a trend?
Well, you can explain it quite simply. When you have the head of the Fed and the vice chair of the Fed come out on the same day saying that they would be willing to consider a rate cut, what do you think the dollar's going to do?
Totally.
It's going to go down. I mean, that's the main thing. Also, people are concerned ahead of the ECB meeting that Draghi isn't dovish enough, and that's happened many times in ECB history, don't forget. So there are plenty of reasons why the dollar has gone down. And the biggest one is, of course, that the dollar had gone up. It went to the top end of the range. So when the dollar is at the top end of the range, which it was in recent weeks, it is set up to slow anyway. So again, the catalysts find themselves, and people explain it using the rearview mirror, of course. But again, I think the dollar bounces from here on a very short-term basis. It's still bullish trend. And by the way, the back test, you know what slide that is, Darius, but the back test, if you back test the US dollar against the 4 quads, you'll see that the only high expected value for the US dollar is slide 36 is, wait for it, is Quad 4. Quad 4 is good for the dollar indeed. So you can see the way to read that, of course, is that the black box is positive as opposed to negative.
Yeah, I mean, you just look at the chart on the left, that's the US JIP model back test with respect to the dollar index. And if the market responds to Fed commentary in a very dovish manner, what the market is telling you yesterday is that the Fed is going to push us into one of these other three quadrant outcomes. Our model suggests it's more than likely to be Quad 3 once you get past Q3 of 19. But again, it could be any one of these particular outcomes. But what you know is that each one of those outcomes is negative for the dollar. And so it's what is this the start of a new trend, or is this a counter trend bounce in equities and sell off in the dollar ahead of what's likely to become more manifestations of Quad 4?
And again, counter trend bounce. If you're a subscriber to your early look, I went through 25 counter trend bounces today, or again, 25 different things I should say rather, which were a lot of counter trend bounces to consider. Again, where are we today relative to the trend? And what we're really good at is getting the trend. And again, if we're to read that, look, you guys just giving stuff away, everything away for free today.
Yeah.
Come on, take that off. Get off. Josephine, stop it.
Indeed. Awesome. Let's get a couple more before we wrap up. Got a bunch of questions here on steepeners. What are your thoughts?
Steepeners? Well, the market, 10's 2 steepened, and 5's versus 2 steepened. So I just say that my thought is what you just probably observed is that today they steepened. The last 2 days, really, they've steepened, and in prior days, they've been compressing. I don't think that's a new trend. I think once the Fed is actually cutting interest rates by enough, that'll be the new trend. Yeah. But again, that's the whole point. We're not there yet. So we've had so many head fakes in steepening. Again, they're not head fakes. They're just part of the trend. The trend has been compression in the yield curve, which is what happens 100% of the time when the economic cycle goes from peak to rolling over to slowing to its slowest point.
Gotcha. You obviously don't. Do you think the 10-year is going to make new lows?
Again, every day I have a risk range for that. Today it says 203 to 235. I think it's going to 203.
Cool.
Tomorrow, I could say 201. Well, some people get frustrated that you changed your mind day over day. I mean, it's like there's going to be a good Stanley Cup tilt tonight. Can you imagine if you get on the ice and you didn't change your mind like every second of the shift? I mean. This is a dynamic thing, right? We're not promising people Tiffany blue boxes of promises of certainties. Again, the 10-year yield our call is going lower. How's that?
Yeah, exactly. That's the only call you can really make. All right, last question here. Jeremy's asking, he noticed the risk range for the 10-year note has been widening.
Yep.
Is this a function of volatility after the new leg of a breakout? And what does the widening range imply?
Well, it just implies that Treasury bond volatility is picking up. So that's called the MOVE index. So again, actually, it's sad, but a lot of people that only watch CNBC because it's free or part of their cable cutting package or whatever it's going to be. This is called, the MOVE. So the MOVE, moving the MOVE.
My favorite chart.
Treasury bond volatility is called the MOVE index. It was plus 20% last week. So when it goes up 20%, what do you think the risk range does? It widens. If the range was like this, it widens. Actually, what's happening now is that the range is going like this. So it's widening the wrong way, which happens 100% of the time when the cycle is obviously slowing. It was a much tougher call for us to make the Quad 4 and Q4 call that we made on September the 27th than it is now. If you measure and map the economic data daily, like we do, vigilantly within the prism of our process, you would have to be willfully blind to not know that the economy is slowing. Okay, and the profits are going negative year over year. That's why you're seeing the move, because the move actually is now predicting that the Fed isn't dovish enough. So if you think one rate cut of 25 basis points is enough, that's probably not right. And that's the point I'm trying to make. Where I'm concerned about being wrong is actually getting back in too early. I haven't done that yet, thank God. But again, that's what I'm worried about, and that's further down into cutting into my fishing time in late August.
Yeah, totally. Do you mind if we show them one of our favorite charts before we wrap up?
Before we say that, though, for people that will never subscribe, I want you to know this. Just because I said that, if you want to go back in late August and say, you said late August, I could change my mind anytime I want, all day long. All of our subscribers know it. We put it in print. We put it in vocal. We now have pictures, cartoons, videos, everything. So that's the whole point. Every single day you have a process, you execute on it, and we all reserve, unless we live in China, the inalienable right to change our mind as free market capitalists anytime, all right? For now, that's my best bet.
Yeah, totally. Did you want to wrap up with the chart? Is that it?
No, you do it.
Yeah, go to slide 72. Josephine's one of my favorite charts. If you don't fundamentally understand credit cycles, this is a phenomenal chart for you to review. There's so much information in this chart. What we're showing here on the x-axis is the MOVE index Keith was just referencing, the Treasury bond market volatility index.
X.
On the y-axis, we're showing high yield option adjusted spreads, the annual average of those two indicators. And the size of the dot is calibrated to the leverage in the corporate non-financial sector. And what I mean by that, it's a ratio of GDP to effectively show how levered the corporate sector is. So what you see is that we're very late cycle currently in 2019. The MOVE index, Treasury bond prior to what we've seen in the most recent 2 months, the MOVE index was about as low as it could possibly get, and this is data going all the way back to the last 30 years. With high yield spreads really just about as tight as they can potentially get at the bottom of any cycle, or at the top of any economic cycle, rather, bottom of a credit spread cycle. Once the MOVE starts moving, it effectively means that the Federal Reserve, the market is effectively pricing in interest rate cuts by the Federal Reserve, and the faster the MOVE moves out, the more the market doesn't believe the Fed's communication. It's effectively forcing the Fed to act. And at the same time, as high yield spreads are widening as they are currently up 74 basis points month over month, that's a real big signal to investors that the Fed is behind the curve with respect to policy easing.
Yeah.
And that's a real big signal. So if the Fed waits till September to cut, a lot of this could actually, these kind of trend bounces, they could really fade and dissipate and actually start to resume what we saw in May, throughout the rest of the summer. So that's the real big risk, is that these dots really, there's nowhere to go once the horse leaves the barn.
Yeah. So again, these are not unlike most of what you hear, read, see in old wall media broadly, is not fake news. These years happen, okay? So this year, 2016, happened to credit spreads. It also happened to earnings. They were broadly negative year over year, but it was isolated into 3 big sectors. So that happened. So again, credit spreads widened. You go up on the x-axis, and as Darius points, you moved out. This is where the dot is today. It's only moved up a bit. High yield spreads have, because everyone's, don't worry, the Fed's going to be good. But again, I digress. This year, 2000 happened, 2001, 2002. Oh no, you don't want to talk about Pluto. That's out there. Right? We don't have to make that call. In fact, I'd say that if this thing goes to here,
that's terrible,
which is a very conservative estimates, you're going to have wreckage beyond what you saw in May for a while here, and the Fed is going to have to do a lot more, to Darius's point, than what the market got excited about yesterday.
You know what the median peak to trough decline in for the average stock, the Russell 3000 in the U.S. equity index, was minus 38% at the lows of 2016. We're not necessarily, again, we don't make targets. We're not calling for that. We're just saying if we go there, December might actually look very favorable.
That's actually why, and again, it's not trying to be trite or to be cute. It's to be right. Mm-hmm. Like our call to get the hell out in 2015 of all the same things, high beta, small cap. Again, the average decline of a stock in the Russell 3000, if you didn't comprehend what Darius just said mathematically, that's what it means. The average decline in a stock was 38%. That means that there were stocks that were down 50, 60, 80%.
Yeah, totally.
Okay? So that's what if I said, well, my price target is at down 21%. I mean, I would have missed the last 17% of that average decline.
Totally.
Okay? So again, wake up humbly. Humbly. Again, God willing, 2 feet on the floor, 2 hands on the keyboard, every single day, recalibrate, reset. It's called Bayesian, okay? It's called a Bayesian inference process. Look it up. And every day, you have a better chance to improve your position. There's no better day than today, every single day, to do that.
Yeah, and then one last thing is just don't be afraid to use time as a factor in time series. People forget time matters so much.
Oh, big time.
You got to get through the calendar catalyst. You got to get through the reporting of economic data that obviously policymakers are responding to. It's not just what your price target is or what you think could happen to financial markets. Time matters. Mm-hmm. We're going to get that Q2 GDP print on July 26th come hell or high water. We're going to get that July CPI print on August 13th come hell and high water. We need to get those things, and the only thing that can get us from there to there is time. Time is a factor in time series.
Indeed. So thank you for your time. You have a choice, obviously, to who you listen to and what you listen to. I say you save yourself some time and listen to this maybe 30 minutes a day, and that'll help you. That'll certainly help you relative to the alternative.
Cool. All right, wrap it up. Thank you so much for joining us, and we'll catch you back here tomorrow, same time. Have a great day out there.